Hello, this is Rick Cortez with a year-end update for the Westwood Broadmark Tactical Growth Strategy. We have a guiding principle that we follow, and that is this. If you never lose more than 10% over time, how much of the upside do you have to capture to match or beat the market? And the answer is 40%, or a little more than 40% over time. I'm happy to say that this year, our tactical growth strategy has captured 50% of the S&P 500. And in our 23 years, we have never had a drawdown of more than 10%. But capturing only one half of the S&P 500's return only makes sense if in certain years the market goes down 10, 20% or more. That has happened historically, but it has not happened recently. In fact, right now, the cycle is up. Two of our major pillars, monetary policy and momentum, are positive. The Fed is poised to cut interest rates into the new year, and there's going to be a new Fed chair in May, and momentum is positive. But we thought it'd be prudent in looking ahead to 2026 to identify three long-term negatives that could come into play and act as catalysts for a more meaningful stock market decline in 2026. Number one, valuations are elevated. The chart on your screen shows Warren Buffett's favorite valuation metric. It is stock market capitalization divided by GDP. And as you can see, this has soared to new all-time highs. This is a long-term chart. It goes back to the 1920s. And we can see that the three major peaks since the 1920s were 1929, 1974, and the dot-com high, and of course, now. Number two, there are three classes of investors who are fully committed to the market. They are foreign investors, U.S. households, and mutual funds. All have more money in the stock market than ever before in history, and they are at all-time highs. There's an old saying, beware of the crowd at extremes. And third, market leadership has been narrow. On your screen, you see that the information technology sector of the S&P 500 now comprises 35% of the total. That's an all-time high, and it also surpasses the dot-com bubble peak. History tells us that when a small group of stocks lead the market up at the expense of the rest of the stocks in the index, that's not a good sign. This happened in 1973 with the Nifty 50. It happened in the late 70s with oil stocks after the oil embargo and the energy crisis. And it happened, of course, at the dot-com bubble top. Now, are we going to see a repeat of history? Is the market finally going to have a 20% or more decline in 2026? Well, we don't know. We don't predict. We adapt. But one thing I can tell you, and that is that the tactical growth team is ready for any eventuality in the new year. So this is Rick Cortez. Happy holidays. Please join me in January for our next update. Thank you.